The following is a presentation of TFNN. The Power Trading Hour with your host, David White. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, David White.
And welcome all to another exciting edition of the Power Trading Hour with me, your humble, lovable, squeezably soft host. We meet every day at this time.
The following takes place between 2 p.m. and 3 p.m.
Every day there's the market's open. But guess what? The market's not open tomorrow, so no 2 to 3 p.m. for you, mister. Put that in your pipe and smoke it. But we will move on. The S&P is off 8 points as we speak. Volume is a extremely tepid 2.1 billion shares as we start the show. No big surprise going into a big 3-day weekend, and the volume's doing a giant yawn along with a movement in the markets. Of course, when we come back Monday and Tuesday, we're basically warming up for fund buying. That will go through Friday. And the question is there anything left in the tank for the market to actually push much higher? We had a lot of no volume up. We've had a lot of no volume down now. What is going to happen when we go into next week? I suspect you don't want to be short, but I don't think you want to be long unless you think that stock is going to have a big short squeeze in it next week. There probably just isn't a great deal of money. I am taking shots where I find them, but they tend to be very short and fairly sweet. We'll talk about that today, and also a pattern that we just haven't talked about lately, and mostly since we played it, and we'll go through the trade in the path of least resistance for the last couple of days. We'll talk about what you should be watching for in the next few days, because I'm starting to see more of these set up, and it is a very good pattern that I think everybody would like to know. It was taught to me by Joe Napoli. We'll talk about how this pattern plays out, some of the rules on it. So why the market's doing a whole lot of nothing, we're going to learn a little bit about an important pattern. In the meantime, it's time to get this party started.
And it's all just a little bit of history repeating.
Of course, we've got the FOMC, we've got the Treasury, we've got all kinds of people. But on this day in 1777, America went into debt, and is foreign debt is the Farmers General of France, a group that collects taxes from French citizens on salt, tobacco, and other products, agrees to lend the United States 2 million livres, approximately $381,000 at the time. The loan is repayable in bales of tobacco. So they sent us cash, and we sent them death in a round stick. That sounds like a good trade to me. But I don't know what else you can say about it other than that. Of course, we are hooked on it like some people are hooked on crack, and that is borrowing money, and it's not so good. What do we got going on? A good and wise decision from the Supreme Court. This decision says that, of course, that tasers are a form of self-defense, and saying that Massachusetts was wrong for saying that its citizens had no right to protect themselves. And basically, this ruling, why everybody's still trying to work it out, is probably a big positive for the company Taser. It used to be a high flyer at the time. Didn't seem to really get a lot of action today. We will take a look at it. Let me actually, TASR. Of course, this one is one of these professional psycho stocks that has been to, man, if I brought it up on a chart, I imagine it was 50 cents at one time and $100 at one time. But we will we'll look at it later in the show. Right now, it's off about 17 cents. Not a whole lot going on here now, but it is and does look like we will have Probably a little bit more juice for people that want to buy stun guns in the future. And I don't know if it's really going to make a difference for the cops. And the only disappointment I have about this is I could not find that little drop from Beavis and Butthead that says, give them the taser. That's worth $1 million in itself. Anyway, that's about it for news that is moving the market. Of course, we're going to be going into a very quiet close, I suspect, today. I've been looking around, if you listen the last couple of days, to that 1225 area on the S&P cash as being kind of where we were going to come back down to. We're at 1228. So that's about where we're at. Now, of course, as I said in the lead-in, we've got a couple of days out here just before fund buying. My guess is that we don't go up in it. If you find a stock that has monstrous short interest in it, and those funds aren't selling it, you can probably look for maybe a little bit of cash in a short squeeze next week, but I'm not looking for that much. In fact, I could see 2050 or 2060 as the high of next week with no problem. Of course, I could be wrong. But right now, I don't see any reason to be putting a lot of cash at risk for anything. That brings us to a pattern, and we will talk about that pattern for a while today because I think it is. I'm seeing a bunch of these set up, and some of my subscribers were asking about it. I always get, of course, new subscribers every once in a while, but I kind of forget it. I hate to repeat myself too many times. But what we did early this week, GDXJ, was look at a pattern. In fact, I've been talking about this pattern since last week, setting up in the GDXJ. This pattern originally comes from a gentleman that was a regular guest. Maybe he was earlier than that. I think the first time I heard him was around 2000 or 2001 on TFNN. He is kind of the original guy that worked on a lot of Fibonacci retracements, came up with a way of putting two different moves in Fibonacci's together to get the confluence levels. Had a bunch of stuff, and some of it's kind of faded by the wave side. He was one of the original traders that actually did a lot of work with CPM computers in the 1980s. I almost said 1880s. 1980s. So a lot of this stuff was done on CPM computers, those big things that look like a piece of luggage that really didn't have much more than a 180K disk drive. So some of them were crude. They certainly work. Some of them work extremely well. We'll get into those. In fact, we'll look at a spreadsheet, and then we'll talk about some of the rules that I like to use in trading what is known as the double repo. And that is a move that is if I wanted to describe it in any single way, would be a parabolic move. And also you get a fairly decent signal that the show is over and that Elvis has left the building. But we'll talk about that when we come back. You have plenty of time to give me a call at 877-927-6648. Email me at path@tfnn.com. And it would be much appreciated because it is going to be a quiet day out here. If you have a question, this is the perfect time to posit it, to opine, to give me your question. We'll be back in a minute.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Dave takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
And we're back. We're going to be talking about the double repo pattern from Joe DiNapoli. It's in his book. His book's like $180 or something. But why there were a lot of stuff in there, I'll probably cover it all today in about 10 minutes for what you actually need to do. So we'll just consider this the Reader's Digest version of at least the part that I use from his book. He started this pattern to look for parabolic moves, and by definition, parabolic moves are not sustainable. They will break, and generally they will break fairly hard. I'd been watching several stocks. In fact, there are more out here that are making this pattern. But you can do it one of two ways. Joe DiNapoli had a thing called the 3x3 displaced moving average. And I'll show that here in a second. I've got the 9-day moving average up now because I know a lot of people have access to that. But what you're looking for is, at least in his original definition, was 8, 10, maybe as far as 15 days above that 9-day moving average or 3x3 displaced moving average. You get a close below it. You get a close back above it. And then if you get a fairly quick pull back underneath it again, it is the signal that the parabola is basically done. Now, his rules basically said that you're looking for a 50% to a 782 percent or 78% retrace from one of these parabolic moves. Now, most of his work was done on commodities, not on equities. So I'm looking for different things to put a logical objective. But after 20 days of moving up, I think we had a call on FCX yesterday. I think that was in Tom's show. Pretty good indication that you've had, basically everybody and their dog get in and go long on something after 20 days. And you can make a pretty good living just taking these ticks off the top, because almost always they do break away, like these GDXJ did yesterday when it popped down on light volume. and that sets up the retrace. And this one, I'm looking at that $23 level. On the 22nd, prior to the close in the newsletter, we took the April 15th, 27. What I wanted to do is make a bunch of cash fairly quickly, going from out of the money into the money. We bought them for less than 70 cents. I think I got mine at 65 cents. Either got out of them at $1.40 before the close yesterday or this morning. So we doubled our money, at least in the options, in one day. Not a bad deal out here. Again, some of the reasons why I probably didn't hold this was that, of course, we're going into a 3-day weekend. And I would see my wonderful, wonderful premium that came into this and mushroomed probably lose maybe 25 or 30 or maybe as much as 40 cents going into a quiet weekend if this thing would come back up. So best to take our cash, but we'll look for another opportunity maybe to play this thing back down to the 23. If you're trading the equity, normally the rule is to wait until the stock actually does have a close below the line. That makes your risk reward correct. Unfortunately, if you're trying to do that with options, you have to anticipate it. I anticipated it correctly in this time, but it could have taken longer for this to actually occur. But what I'm actually saying out here is that, basically I saw this thing on the 22nd, really had no juice. We had all the terrorism thing. There was every reason in the reason in the world for this thing to go pop back up, start having a lot of juice. Basically, you had 3 days of no juice. So we went ahead and took the trade, and that was anticipating a close below that line. Now, I guess there are a few other things out here that are kind of tricky, and that is occasionally you'll get a day where you do get a close below the line, and in this case is on March 1st. A single day like this, that just closes under a little bit, doesn't have a lot of volume, about 13 million shares that day, does not negate the pattern. I don't like to see 2 or 3 or 4 of them. If you start seeing them, then you get into a different pattern. And I think when I talked about FCX yesterday, this is probably a better example of it. You've got this kind of thing here, but you already had 2 days where this thing was under it and above it and then closed back below it. Now, the only thing that you would say is, where does that pattern actually start? You had 2 days on the 10th and 11th of February underneath that line. They weren't that much, but I'm just going to count and future count the ones basically from the last penetration of that line. It's called a double repo because it's a double re-penetration of the line. On this one, I would have started the count for being above the line for this on the 12th. Now, you really didn't have a close below it except on the 15th. It was 1 day. It was volume, came right back into it. So as far as FCX is concerned, I'm not playing this as one yet. If this thing would go a couple of days sideways, remain under the line, come back up, maybe get back up to $11, go back over the 9-day or the 3-day displaced moving average, then close down, I would probably count that as it. This is not a pattern where you want to just take 1 day and that's it. It takes a while to set up. And of course, there's a variety of ways to interpret these, but I don't get too wigged out. Now, the art of timing the trade charts does have the displaced moving average because, of course, I wrote it. Here's where this one probably doesn't look near as clean as you thought it was going to be using the 9-day moving average, and that's one of the reasons why I use both. I actually like the 9-day moving average for a couple of reasons. One, it is a bit smoother, gives you a little bit better trend line. I like the 3-day displaced moving average because it gives you the numbers going forward. And when we get back, we'll talk about that. But for the most part, in fact, well, I'll bring the spreadsheet up here now. The 3-day displaced moving average basically takes the last 3 days, which in case for today would be the 23rd, 22nd, and 21st. You average those and you put them 1 day forward. So as long as the GDXJ closes below $28.22, you have that pattern intact. The next day, if it closes below $28.53, it's still intact. And $27.99. Well, we're going to close well below that. We've had a big move. It came on big volume. So when you look on the side, in fact, I just made this little spreadsheet so you could see, and it says above, if it closed above the closing price of the 3-day displaced moving average. And you'll see, occasionally we'll get one of these blows, and it's not much. And it was $25 that day, or $25.22. It closed to $25 on the first. And that's basically what you get. You end up with these days where maybe you get one below, and it's not much, maybe 10, 15 cents on a $20 stock like this, and you're right back in the pattern. Don't get too wigged out if it just goes a little below and you don't have a lot of volume. We'll talk more about this as we get back.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now. Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Direction's daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
And I'll hammer the point home just a little bit farther. Why the 9-day moving average can be used. You probably will just want to average the last 3 days and figure that is your number where you don't want the pattern or the actual equity or stock to go back over. Again, a lot of this stuff was originally used in commodities trading, not so much in equities trading, although I've seen it work extremely well in both. I'm not the biggest commodity trader in the world, but I know a pattern when I see it. And one of the questions we have in the den, of course, you can email me at path@tfnn.com, or you can put it in. And the questions, we basically wanted me to look at the S&P, so we'll do it on the SPYs. What you'll see is something like this, which is a lot tougher. Let's go to the just a traditional moving average. You've got kind of some of that pattern. That's kind of why I'm bringing this up now, and we've already seen it crack in gold. But you haven't seen that pattern develop yet. We've got the first step of it in the S&Ps. You could basically, I would say that the first day of this pattern developed on the 16th of February. You had basically every day since then, except today, in the SPY. Above that, you closed just a hair underneath it yesterday. Now, what you want it to do, of course, and a lot of people will differ on the interpretations, but I find it makes much better trades. You don't want just one day and then you want this thing to pop back up. Well, say we have Monday and Tuesday that are right in this level. Maybe we play around at 20, 35, 20, 30, 20, 40 or something, just below this line. And then we go back above it. There is no signal yet, and you don't have to yell and scream that the wheels are falling off the wagon. What you do, though, is the next time this thing goes back underneath it, if it does without really some wild gyrations, that is the trigger to pull the ripcord and parachute out of this plane that is going down. Now, Joe DiNapoli never did any of the work with volume, although we've had just infinitesimal volume over the last week, which is not good. But it would not be a surprise to me maybe to open up a little lower, maybe hit this gap that happened back in the SPYs on the 11th, then come back above that. And all you want to do is make sure if you are bullish that you get volume, you get strength, you get everything that says a sign of strength when you go back above that line. If you don't get it, then get ready to pull the ripcord, because that's when this pattern really plays out. Nuances between the 3x3. The big advantage of the 3x3 is it turns a little bit quicker and on for some things. But like I said, I would rather use the 9-day moving average for setting up the trade, and then use the 3x3 actually to figure out where I need this thing to stay under to stay in the trade. So my stop point each day, in fact, the Art of the Charts does it. If you actually click on the little button on the 25th, it's not going to be tomorrow. Actually, on Monday, you don't want this thing to, if this pattern had already developed, let me put it that way, you wouldn't want the SPYs to close above 204.54. Then when you get to the next day, you wouldn't want it 204.15. And then when you get to what will be now Wednesday, you don't want it to close over 203.35. So you kind of see that this line or this average starts setting up a declining, almost a trailing stop in the way that these things come about. But again, I'm suspecting that this is going to act a lot more like the GDXJ did. Probably going to get some buying, probably even starting on Tuesday, I think, maybe later Tuesday, into fund buying, to push back up. If there's no volume in that thing, and this thing closes back below the 9-day moving average or below this 3x3 displaced moving average, either one, I would probably pull the trigger on it. But volume's going to be the key. And it is almost always best in these bigger patterns like this to, if you're just playing the equity, if you're not playing the options, to not anticipate, but wait until you get the signal and then pull the trigger. Because there are a lot of false alarms, a lot of variations on this where this pattern does not come in. But if we want to go back to the GDXJ, Yeah. That was one of the ones where it worked very well. Steve Rhodes is in the den talking about 11/1/2007. But yeah, I'll have to go back and look at that. But it is one of those times where you see these giant failure patterns develop. And again, it starts with a parabolic move. The definitions of a parabolic move is one that can't be sustainable. And normally what you see in these is just that. You see the unsustainable move. Now, originally, a lot of people talked about a pattern called the parabolic SAR. I've kind of moved it off my radar for a long time, mostly because it just doesn't seem to work as well as the Joe DiNapoli double repo pattern. Normally what happens if you just use a parabolic SAR, we're already on the sell signal for the SPYs. That doesn't mean, though, that a whole lot to me, because the whole kind of dance that goes on at a high, the give and take, the real signals that come in with a double top really are much more common than just going to the top and having a total failure and the wheels fall off the wagon. Normally, you get at least a couple of attempts, sometimes as many as 3 attempts. The volume totally falls out. No one buys the breakouts, and that's where they all fall out. So not a prediction yet on the SPYs, but a warning that a pattern could be developing in the way that these things work. I'll check my email and see if I have. I got another one. Not on this. Anything else? I think that's it. If you like a copy of this spreadsheet, just email me at path@tfnn.com, and I'll send it to you and see how to do the math for the 3x3 and actually make it print the nice little above and below. But if you just look at the 9-day moving average, you should do fairly well on it anyway. I don't know if there's a whole lot to say about that. Question in the email about FCX again, in the same thing, and that is, let's go back to the traditional moving average. The 9 really smooths out these moves. Don't get too freaked out about the lows. If this continues down, then pretty much what I talked about yesterday in Tom's show applies, which is I'd be looking at this bar of March 2nd that had 84 million shares on the way up as support. I mean, we're not that far away from it right now. I would just like it to get a whole lot more into it. When we come back, we'll look at more stocks that are moving in the market, but we have a few patterns, a few dark clouds on the horizon. We'll be back. Oh, I got to talk about Andy's show. He's going to bring up something real neat, too.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
If you're looking to discover a new financial resource and diversify your financial portfolio, consider the new Market Safe Commodity Solution CD from Everbank. This 5-year U.S. dollar-denominated CD gives you exposure to 8 equally weighted commodities, including WTI crude oil, gold, silver, copper, nickel, soybeans, corn, and sugar, in one powerful CD. With annual pricing caps of 70% per component, you could earn up to 70% upside payment at maturity if the commodities increase in value across annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on this indexed CD. Don't miss out. Take advantage of this financial resource designed to grow with the times. The April 14th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once again, that's everbank.com/TFNN. This advertisement is sponsored content. Everbank is a member FDIC.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Andy Heck and I had a conversation. Oh, boy, I tell you what, if it was just us two guys and you had a quiet recording of it, I think it's some of the most hysterical conversations of my life. But he did want me to bring up that instead of at 5 o'clock today, he will be coming in at 4 o'clock to do his Technomentals hour. So make sure and set your clocks ahead 1 hour earlier for him at 4. But we were talking about options, I don't know, somewhere around noon my time. And he had a kind of a great story, one that doesn't occur very often today. There's a reason why puts are called puts, and that's because they can be put to you. But he has a great story that meshes, of course, with what happens this weekend. That is, of course, the religious rights of this weekend, plus the stock market, plus I think it's 1995. I think it's 1995, and adventures in the silver and gold market. It's a very interesting story. I think you'll want to listen to it. And of course, we've got Tom in the next hour to wrap up the week and what's going on. Disturbing. Everybody's going at it in the den today. Wanted to get to some other stocks out here, mostly of ones that are moving before the end of the day. But I think I got everything I wanted to talk about yet today. And is that movers? No, that's not it. I got to get to this one. Where's it over? Keep moving things around in these windows and trying to get them right. But I wanted to look at a few of the stocks that had actually moved a great deal. Let me get this one correct here. I've got them ranked. So I wanted to look at them and see which ones were much more look entering. Concordia Health Corporation. It's off 11% today. Let's take a quick look at that one. CXRX. Take a quick look at this guy. Concordia Health. Let's get a few of these things off the line. Not a lot of volume, of course, in a lot of these that have moved down fairly significantly. But this one's been quite the mover, hasn't it? 10% moves, many days going on. Not a lot of volume out here, but that does set up at least a big move with no volume, hopefully, into the February 11th low. That's $23.76, just 250,000 shares today, if this is right. If this is right, let's take a quick look. What do we have so far today? Oh, 624,000 shares. So that's going to be a bit to get into this, probably enough to get into this February low, but you'll want this thing to actually quit going down at that 23.76 and the volume to shrink. But in fact, I brought it up. Maybe I've got it out here. The one more thing that I wanted to show in patterns, maybe I can find it here in the segment. But we have a bunch of, where's it at? Let's see if I can find it here. There it is right there. A lot of patterns setting up in this market. And the other one that is preeminent, at least for me, is a big asymmetrical triangle out here. I'll try to, yeah, I can zoom in on that a little bit. But it's not just a single stock. It is a great deal of stocks that we either have in parabolic moves or that we have in these asymmetrical triangles. I bring these up from time to time, too, so I probably ought to talk about this, especially since I put it in my newsletter today, and I'm sure I'll get questions about it on Monday. We'll just handle it today. What happens with a stock or an equity or a market, and that is lower highs and higher lows. You get this kind of period where this thing just continues to get narrower and narrower trading ranges. Now, the original idea behind this, I don't know where it came from. I heard it from Tim Ward. A lot of these things, the lineage is somewhat confused. But certainly what happens is you kind of start with drawing a big triangle on these patterns with lower highs and higher lows. If you can get about 75% or 80%, depending on who actually is telling the story, I've heard it many ways, but 80% is kind of the way I look at it. If it goes 80% into the apex of what will be this triangle, then you've got the pattern. And about 80% of the time, I've seen this work a great deal. The first breakout of this and these trend lines tends to be the false move. So I'm going to be probably talking about this next week and looking at more of them on the show because, of course, why not kill two birds with one stone, do my research, and enlighten you at the same time. But when we look at these continued moves, I'm going to say we're 75% into this triangle. Now, sometimes I see them go all the way to the end, but fairly rare, maybe 10, 15%. This would suggest that probably in the next 7 to 10 days that we're going to see most of these break out. And, of course, if it breaks out, you want to fade the breakout if it doesn't have a lot of volume and strength. If it breaks down and doesn't have a lot of volume, you probably want to look at that as a false breakdown. So this is kind of a contrary play in that the first move out of these is probably a head fake. And especially when you get into light volume markets, I see a great deal more of stocks that do kind of weird things and kind of meander off the path. But you got a lot of volume, a lot of people interested, a lot of things happening. It tends to kind of keep the market in check from people willing to manipulate it, at least in the short term, or it's harder for them to do it because, of course, there's a lot of cash coming in and out. But what we see in days like this and maybe even into the next week starts a pattern. And again, as I said, the pattern is kind of a couple of days. We got fun buying through the end of the next week, and then we get into April. What happens in April? Pretty much by the end of the first week in April, we're right back in earnings seasons. So we can start seeing a great deal of what is already set up into the earnings season of last time kind of set up. So I'm not making any big projections. I think it will probably, the move that everybody's looking for in the market might bore everybody for another week or 10 days. We may not have anything other than maybe options with short squeezes that can make us, at least make me a few shekels along the way. But not a whole lot out here that's saying that these patterns will be hit. And again, then I start looking at stocks like FCX. And if that starts moving up next week, we see light volume, we see a double repo pattern in it, maybe the commodities are what's going to lead this market down. Not a prediction, but just kind of what I can see It's kind of like looking at a storm way out there. Is that storm headed this way? Could be, but not guaranteed. Maybe it goes north, maybe it goes south. But normally, if I'm set up for these and know what I'm looking for, I know a lot better how to play them. Like I said, the GDX trade started to develop last week. We only made money on it this way, and that's kind of the way that double repo works. You got to have forethought and foresight, and many traders don't have it.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Tom O'Brien, professional trader and educator, founder of TFNN. Also, a special guest on CNBC. Tom will bisect and dissect the markets. The Tom O'Brien Show, next on TFNN.
And as we're back, going to look at a lot of these stocks that are moving out here today. Let's look at some of the winners. PVH had some kind of deal rolling out here, so let's take a quick look at it. PVH. And certainly did pop up. Nice volume, too. It's breaking its high of December 2nd. That's 1.5 million shares with 2.5 million shares today already. So think everything you need out there. Decent sign of strength, nice gap up, decent energy on the way up. Let's see if you have anything bigger out here. You've got a big volume day down. This is going into of 3.6 million shares. That goes back to the 23rd of October. So you have to look at that. Let's take a quick look at the news to headlines. I vaguely remember what it was, but let's just make sure. Earnings and sales beats. Okay, good enough. Better than expected top and line bottom results. The company jumped to 4.5% after the market earnings. And this company does what? Profile. Let's bring that up real quick. I kind of vaguely remember this company, but I don't remember it enough. Men's and women's apparel and accessories, branded dress shirts, neckwear, sportswear, jeanwear. This has been a segment that has done horrible for a while. Well, they got all the brands. Jeffrey Bean, Cole, Kenneth Cole, Michael Kors. They do all of it. Donald J. Trump. Signature collection. Anyway, okay, so they're big into clothes, and I guess a few people are out there buying at them. What else do we have? KB Homes also had a little better than expected news. It's up about 6% today. And is it trading out here at KB 1388? See if there's anything else out here on this one. Open that link, do that. So up 79 cents. It's got to 8 million shares. We're into that. I guess I should actually type in the right one, shouldn't I? KBH. There we go. KBH. So you've got fairly nice pattern out here, which is different than the one I was looking at. So never mind on that last bit. Well, it looks like 1450 from the December 1st is out here, 2.3 million shares. You got 6.2 million shares. Actually, almost 8 million shares now in KBH Homes. So you have tons of volume. Not very happy about having a nice big doji out here. Energy is about the same from the way down from that December 1st high to the January 20th low to the February 11th low to this high here today. What I dislike is that you didn't actually pierce that January 20th low at 904, so I would have stayed away from it. But like many of these companies out here, you need to be watching very closely for those 9-day moving averages. Now, this one is the one that would probably be in the danger zone. I would probably discount a little of that because of the huge volume up today. Probably more, as much as a sign of strength that I don't like, it's a sign of strength just the same. So it probably would negate this pattern on a double repo, and that's one thing you want to look at. You've had your close below, you've gone above, but you got a lot of volume out of it. Much more likely in a trading range or something else than a double repo pattern. You want to see that volume really tap out, maybe a couple of days. Anyway, that's it. Hang on for Tom O'Brien in the next hour. And, of course, a very special Andy Heck show at the 4 o'clock hour and talking about putting it to the man. I want to hear this story. So when you can, not when you have to. We'll see you Monday. Same bat channel, same bat time.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
You're watching Tiger TV.